Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 31 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Lincoln. Joining me as ever are the three other horsemen of the apocalypse. Carl, the voice ridger, Alan, the storyteller Smith, and Andy Hart. Now, gentlemen, we have a show.
Nick, sorry to interrupt so soon. Just your backdrop looks a bit different. Are you not at home?
No, thank you. I'm not at home. No, I'm in my parents' place in Benarafi on the Costa del Sol, about 20 miles east of Malaga. My dad was playing petanque in the garden last week with my brother and his family. Petanque is the Spanish version of boule. And if you don't know what boule is, it's basically a game where you throw metal balls into gravel, and it's duller than that in reality. Anyway, somehow he managed to fall and break his leg playing petanque. So I'm now here managing the fort with Mother, and Dad has just come out of hospital and gone into an assisted care rehab facility, and he'll probably be there for the next 3 to 6 months as they work on his broken leg and getting him walking. I know. And then this morning I found out he's also got COVID, so we're not sure whether we can visit him now and what the restrictions are. So I've packed Mother off, so I've got a quiet house because business comes first, and she's going to the care home anyway to see if she can bustle her way in to see him. My mother was a force of nature. The Spanish won't know what's hit her when she turns up at the rehab place. So that's where I am. So I think now
we wish him well. Wish him well, Nick, and well. The show must go on. It's great that you've continued. Have mic, have headset, and the podcast goes on.
Yeah, I think we're two all now, aren't we? You've done 2 overseas ones, I've done 2 overseas ones, and Andy and the voice are yet to get off the mark. Well, Carl never will get off the mark, but he's very solid in Limerick, but take him outside of it. The boy dissolves.
Anyway, best of luck to Father Lincoln.
Thank you very much.
Send him our best wishes.
Thank you guys for your support behind the scenes.
Are we quickly going to shoehorn the England game in? The England semi-final was a pretty rough game to watch. In the end, obviously, SA won by a point. I think even the neutrals felt sorry for England, which says a lot about the game. Anyway, any other brief?
Come on. I wouldn't make sweeping generalisations like that.
That's anyway, not what you said in the WhatsApp group. Come on.
Fair play to England. They stood up and they were counted. Owen Farrell is a magnificent rugby player. He really is. I'm really looking forward to the 3rd and 4th place playoff match against Argentina, which I think is on Friday, just to watch England celebrating the Argentina knock-ons like they've won the World Cup, because that was definitely a feature of their play during the tournament.
That's true.
That grace period was very short, Carl. We enjoyed it when it was there. Right. Okay. Are we ready? Mr. Hart, are you ready to give us some more of your super high energy read reviews, of which there could be any number from 2 to 4 to 5. I don't tell you the number anymore. Crack on.
Anyway, today we've got 3. The first one is from Jeremy Squibb, who's a good friend of mine, great financial advisor. It's entitled The Conference Bar Available on Demand, 5 stars. This is a wonderful mix of views, opinions, thoughts and ideas, a wise and insightful discussion and great fun. These are the conversations that we value most as financial planners. Thanks, chaps. Keep up the great work you do. Next up is from Addict281818, entitled The Real Not So Hidden Gem, 5 stars. Great listen. Every new episode seems to be better than the previous one. Good chemistry between the 4 of you without having to agree on everything. Makes me think of my single advice business, the service I offer to my clients, my investment philosophy, my evolution to being the best I can be. Martin Shades, MJS Financial Management. The final one is from Bosch Jan, entitled Only 5 out of 5, 5 stars. What a refreshing, honest, sincere and helpful podcast this is proving to be. As someone who transitioned to the profession 4 years ago, the tips, tricks, dialogue and unbiased views have helped me transform the way I think about doing business, and all for the better. Thank you for the great pod. Back to you, boss.
Great stuff. Thanks, Andy. Yes, so thank you very much, guys, girls, and those in between for those reviews. They are really, really important to us in numerous ways, mostly just mental reinforcement that what we're doing is of value. And thank you also for putting your names in those reviews if you want to do so, rather than just use an anonymous hashtag. That's great. And just, I think, engenders a bit more community, which is what we're all kind of about, because this show is as much made by you as it's made by us for jabronis. Okay, so moving on to the topical tidbits. Yeah, we got a lot of really good news stuff this week. And well, let's lead off with the big thing, the SJP, and maybe Consumer Duty doing some decent duty. Alan.
Well, yes, this was obviously the biggest news in our sector of the last couple of weeks. And the news is that St. James's Place, the largest wealth management group in the UK, announced some fairly sweeping changes to their structure, their fee model, their overall setup. Yeah. I mean, the fact that their share price has halved in the meantime as a result is only part of the story. I mean, the brief headlines that I've read so far are that they are planning to remove exit charges. This was the most egregious part, I think, of the whole St. James's Place setup, was that they had potentially, you carried a 6% exit charge from day one. Obviously, it decreased over a period of time, but that was the one that was felt just completely out of sync with the rest of the market, certainly since the Retail Distribution Review, which is over 10 years ago. So their plans are to remove that. They've also announced plans to introduce more index funds as a range of options, presumably lower cost index funds. And I'm sure it's completely coincidental that it was about 6 months ago that we discussed St. James's Place on this very podcast and raised those very specific issues and points. I think, broadly speaking, our view was sort of balanced towards slightly positive in terms of their impact across the whole sector. We took a few bullets as a result of that from the sort of hardcore independent advisors, Mr. Hart in particular. But the kind of those standout issues that we did highlight as being just not in line with the modern sort of financial planning business, they've suggested they are going to change. Yes, it's not going to happen overnight. They've had a few sort of negative comments in that I understand these changes are not going to be brought into the end of 2025. But, this is a huge organization. This is a 150 billion assets under management FTSE 100 company, and I don't expect them to flip overnight. There's a huge amount of knock-on impact within this as well in terms of the structure, how they recruit advisors, how they lend money to advisors to fund practice buyouts. There's a whole lot of knock-on second and third order impacts, I think, that have yet to be fully understood. The last thing I'm going to say is for a detailed breakdown of the kind of complexity of the model, our friend, Mr. Abraham Okosonia, in his podcast, I don't know if anyone's listened to that, Advisor 3.0. Yeah, he does a sort of deep dive on all this stuff. It's quite interesting that he unpacks much more than I had understood about the model, how it operates and how it's likely to change. But I would just say for a company of their size to make these changes, it's so refreshing because most organizations, most listed businesses are concerned only about the next quarter results and therefore their share price. And to take a very bold decision that is effectively halved their share price with the view to presumably the very medium to long term, I think is very bold and should be applauded, frankly. What are your thoughts, guys?
Yeah, totally agree with that. And sorry, I'll come to you, Andy. I and also, just be careful with those IFAs who are passionately against SJP for various reasons, whatever they may be, valid or invalid. Just watch out, because if SJP really do make a transition to being more passive based, I'll never go entirely passive, but more passive based, certainly more financial planning based. I mean, I know that Andy does a lot of training with them on Voyant SJP, so they do use the cash flow modeling. If they start using passives, embracing full fat financial planning, and then you've got that advice guarantee, and you've still got the nice cartridge paper and the nice swanky country homes for the seminars, which people, it's going to be a pretty compelling proposition. So just and they'll this in time they will come out of this stronger. And as you said, Alan, well done on them for having the balls to do it, seeing the share price drop off. But they're nothing else if not long-term visionaries, the people behind the SJP brand. They'll know there'll be short-term pain, but long-term this could make them even more powerful, I think. Andy.
Yeah, a couple of points. I do quite a lot of training with them, so I see it from the inside, and they're certainly heading in the right direction. I echo what Alan and both of you said, Nick, about large firms making big decisions, which is great. I mean, my real problem is with the purely investment managers that charge close to 3% for absolutely no financial planning, no financial advice, no money flow, no tax planning. The real pirates and pinstripes. These are the firms that I hope they're going after. Yeah, the firms that just do investment management and none of the good stuff. I mean, these are the ones that, as I say, hopefully they'll be going after. The other thing about, obviously the share price being hammered, this is good news for end consumers. What I mean by that is the Transact share price has also been hammered because they don't skim off cash. I think Transact could double their turnover if they just skimmed off cash. They could be clearing an extra 50 million a year if they skimmed off cash like all the other platforms. So again,
I agree.
A slightly unconnected point. Over to you, Carl.
Yeah, look, I think it's I just echo what everyone said. It's a ballsy decision from them. They're definitely taking a lot of short-term pain. I would be an investor in the SJP share price now because I think they've taken what you don't often see with these bigger organizations. They've taken a long-term view. And I think I'd be worried if I was an IFA in the UK, honestly, because you don't see this very often, and more power to them. And I'm really glad they listened to our episode and they took it on board and they decided to make some real change.
There is without doubt. I think we're unanimous on this. It was our episode that caused these changes to happen.
It was the only reason.
I think this has been brewing for many years. That they're saying this is their biggest.
Enough, Andy. It was just because of Trap.
Okay, their biggest change in over 30 years. So it's enormous. Anyway, back to you, boss.
But seriously speaking, I know you've been working with them on transitioning to doing some real financial planning, and that's been kind of going on for a number of years. So this has obviously been in the offing. So be careful what you wish for, as Nick said. Yeah.
Okay. And bottom line is it's good for consumers, and that's good for everybody, really. I think so. Mr. Hart, yes. Humans under management. You have the London shindig. You have the Cape Town shindig. There may be 2 other countries that are willing to have the shindig come to them. Speak on.
I'll very briefly mention if this is anyone listening to this that is connected in either Sydney or Dublin. I did a show in Dublin once before, and I'm planning on doing one in 2024. So I'm speaking to the right people, the right companies, the right organisations. So if that is you listening and you are based in Dublin and you're a consultant, an investment house, financial advisor that wants to help me sort of put this on, then that would be great. The idea is to sell out a room of 300, 200 as a minimum. So that's very briefly about Dublin. I'm also speaking to a couple of people about hub in Sydney. So if you're an Australian advisor listening to this and think you've got some connections and can help me with that, then please do, again, reach out and send me an email, whatever. Go to humansundermanagement.com and hit contact or something. But anyway, that's it. Very briefly, back to you, Nick.
Great stuff. Alan and I have got some time booked in actually with an Australian advisor based in Sydney who made contact with us via a Loom video, and for his creativity, we thought, we'll give him some of our time. He just wants to know a bit more about what we're doing and so forth. So I'll mention Sydney to Marcus when we chat with him, Andy, and see just sow that seed at his end with an Oz IFA or equivalent. Mr. Murray makes another appearance. Mr. Hart.
Yeah, so Nick Murray last week was 80 years of age. He's had the biggest impact on me in my career and life and everything. The joke is we wake up in the morning and we roll our mats out facing Brooklyn. So Mr. Murray's 80 last week.
You mean you? You, the only one in the world.
I think 3 of us on this call have consumed a lot of Nick Murray stuff. I think Carl is the one that's consumed the least, as maybe an assumption.
He just gets it from you.
Yeah. So happy birthday, Nick Murray. Thank you for all the good that you do. I think Nick Murray's newsletter's got about 4,500 subscribers worldwide. He says that's 1% of the advisor workforce. I believe there's about 450,000 financial advisors worldwide that try and do the good stuff for clients, and he's got 1% of those are part of his gang. So happy birthday, Mr. Nick Murray.
Okay, thank you very much, Andy. Mr. Smith, the NextWealth benchmark report. Make this sound more interesting than it reads.
I often read these. They come out periodically from various organizations. I think I mentioned the Schroders one quite a few episodes ago. Next Wealth. This is Heather Hopkins. Some of you know Heather. I think she's a good egg.
I met her
you
at
met her.
the Sissy thing at Wootton Hall in Surrey. She was really good. She's good fun. Yeah, she's she's strident. Good.
Strident. That's a word.
Yeah.
No, she's good. She's very positive. She's obviously a consultant to the sector. Her organisation is called NextWealth. They produce publications. They do research reports. I think they have their own conference. And I just happened to read the latest one, and I've posted a link so anyone who's interested can download it. I just think it's quite interesting. Just keep your finger on the pulse. We can. The danger of people like us, and maybe some of the people listening to this podcast, is we kind of live in a bubble. We assume that all the rest of the sector is exactly like us, talking the same way, charging the same way, have the same sort of operating model. So it's quite useful just to spend 10 minutes reading through these reports, which she goes out to the market, does her research, or her team does. I've singled out a couple of points which I'll just highlight for this conversation. The general view is that the industry is fairly flat right now, and that's probably reflective of general sort of economic conditions, high interest rates, etc. Interestingly, let me see. Well, talking about fees, let me talk about fees, for example. Fees have come down. This is interesting as it relates to SJP as well, everyone. Fees have come down from a fairly steady, the last few reports, 2% all in to 1.75% all in. That seems to be the benchmark standard for advisory, full package, financial planning, investment management platform, etc. Across the 1.75%. I'm not sure whether you think that's high or low. Nick?
Sorry, does that include, if you did say it, sorry, I didn't hear it. Does that include sort of DFM, kind of the Brewing Dolphins and that kind of thing?
No, I don't think they get invited to participate. This is more, and there's very specific reference to the word financial advisor and financial planner. I'm not convinced that those organizations consider themselves to be financial planners as such. They are discretionary fund managers, aren't they? Because I think from all our own research, we'd identify the fees being at least that, if not more, for those organizations without full-fat financial planning. But that seems to be in the financial planning sector, and there's an increasing number of advisors calling themselves financial planners, and it refers to in this, down to 1.75, which is quite a significant change in the last 12 months, from 2% down to 1.75. So fees are heading lower. And on average, it says only 50% of firms are planning to grow by taking on new clients. 45% aiming to increase assets under management. So it feels like a fairly, sort of static market that a lot of firms, at least half the market, according to the survey, is kind of holding steady, not looking to hire anyone, not looking to take on a lot of new clients. This is the feedback. That seems punchy
to me, Alan. That does seem.
That's the research. I don't know how many firms. There's certainly within the hundreds of firms that have been researched. And a significant number have been approached in terms of, a number are planning to sell their firms. 16% are planning to sell the firms, and half the market has been approached to sell the firms. So there's a few sort of bullet points there worth having a look. If nothing else, just sort of identify how your own organization fits with the broader market as in terms of the people who've been surveyed. It feels like we're currently in a period of kind of transition, maybe holding the ship steady, high interest rates, etc. Not looking to recruit a lot of people, not looking to take on a lot of clients. So interesting. Posted a link to it in the show notes.
Okay, thank you, Mr. Smith. Appreciate that. Now, Voice, the Irish budget, not great for investors.
Yeah, so the budget was last week, the week before, I can't remember. But anyway, so there was very little really changed in it. There was kind of significant change in the previous budget with regard to PRSAs. There has been a little further tweak that basically all pension contracts in Ireland are going to be heading down the PRSA route, which is kind of good because you've got only two now. You've got kind of master trusts and then you've got PRSAs. So it does take a lot of the complexity out of it. And there are some good rules around PRSAs that you can't have exit fees and that kind of stuff. So it is better for the consumer. And there's some kind of good rules in there in terms of what advisors, and contribution levels. I've spoken about that before. But I suppose the big one was we were hoping in this budget that the gap between exit tax on funds, which is 41%, and CGT, which is 33%, that might be closed. And it hasn't been closed. However, the minister did say that he has now asked for a report and that the report will be back to him kind of next summer. So we'll be hopeful for some kind of changes in that in the budget next year. The problem with that, of course, is that I have come across a couple of high net worth folks who feel that, by investing, just buying shares themselves, that they can kind of replicate. They certainly couldn't replicate a DFA World Allocation Fund that has 13,000 stocks, but they're going, oh yeah, I could probably replicate or get close to an S&P 500 index, right? Because that reduces my tax rate from 41% on my gain to 33%, which is not insignificant. But this is the classic case of the tax wagging the tail of the investment dog, right? You cannot try and replicate an S&P 500 by doing it yourself because of trading costs, because of rebalancing, because of tax issues. You lose all of that potential gain by trying to do it yourself. So it doesn't make sense. But having said that, it also doesn't make sense that CGT and exit tax have this vast differential. And ultimately, I suppose my feeling on it would be that consumers would be much better served having the two tax bands around the same, because they are much better in funds whereby professional managers are rebalancing and tracking the market and managing that tracking error, etc. So that was kind of a little bit disappointing, but it is in the pipeline. So there's just one other point from the budget, but Alan, you have a point to make there.
I just wondered whether ETFs are considered individual securities, aren't they? Although behind them they are, thousands of underlying securities. What's the view? Presumably you access ETFs in Ireland.
Yeah.
What's the tax difference?
That's pretty smart for you, Alan.
Thank you.
Yeah, but they have exit tax on them. So there was some way of buying, if you bought Canadian ETFs or something like that you could avoid the exit tax, and it was just mad stuff. So yeah, exactly. So yeah, it is a challenge. I'm actually talking to
Canadian
a few clients about
ETFs, but only on a Wednesday.
Yeah, well, and Andy, do you know what? You couldn't have put it better, right? That's exactly it. And it was like, and then they stopped it. So now people who have all got all these Canadian ETFs are going, oh, Jesus, how do we unwind this?
Double screen.
Yeah. So it's, I think simplification of the whole thing is just, tell us, work out what tax you want out of this thing, and then just try and equalize it across everything. So that's kind of my view. The other big one, by the way, was EIIS. So I think do you guys call it EIIS? So it's investing in startups and that kind of stuff.
EIS, yeah.
Yeah, so we call it EIS. That's changed in terms of how old the company is, how big the company is, in terms of your the tax relief that you can get. So they become much less attractive. And look, here's a point that, regulation can all of a sudden wipe out businesses or make them much less attractive, because I know firms who are only doing EIS funds, and now they're going to have to talk to their clients about, well, we have, I think you get the higher tax relief on the much riskier ones. So startups who are less in business, less than 2 years or something like that. Of course you are going to, but that's very high risk. 90% of startups fail and all that good stuff. So look, a few changes. They're kind of minor tweaks, but at the same time, it seems like we're heading to a better place, because we're definitely in a better place as of last year's budget in terms of pensions and PRSAs and that kind of stuff. I won't go on much more. It's kind of technical stuff, but I suppose for any Irish advisors out there, important that you do know this stuff.
Andy, Alan, myself, I think Carl came across there as actually understanding what he was talking about with that budget, didn't he? That was masterful.
It's the first, isn't it?
He's reading straight from a script. It's obviously one of his colleagues have passed him something.
Yeah, one of his colleagues put a script.
Can you read this out, please, Carl?
I'm at home. See, these boys are always saying that I don't really know what I'm talking about, but I might ham that. Right. I might ham that up a small bit.
Yeah.
Thank you. Okay, so we're going to come back to the point on we'll do that. So, voice storyteller, you went to a business strategy workshop run by DFA, Dimensional. Tell us about it.
We did indeed. This is, I suppose I was attracted to this one because they were going through the DFA do a study that if you participate, you get all the results back, which is really, really good. And it kind of helps us in terms of what are the metrics that the best performing advisors worldwide are looking at. Look, it was as all the DFA conferences are. They're done really well. They're slick. I would have honestly preferred a little bit more on that financial advisor study. They did a kind of an hour and a bit on it at the start. I'd have loved 3 hours on it, but I guess probably not everyone would have. But I'm going to delve into a little bit more detail with the DFA folks. The one thing I was struck by in the event was the quality of advisor there, and it's just better than anything else I go to. And the connections and the contacts you make. And there was a few advisors over from Ireland, and I managed to kind of have kind of direct discussions with them at it, and we've agreed to kind of link in a little bit better because there's not too many of us doing the financial planning and the DFA and that kind of stuff. So we can only help each other, and I think there was definitely a feel for that. But also then meeting some advisors who are on this journey, and this was more kind of UK folks that I met, but there was some German folks as well. So it was really interesting hearing their stories as well. And I just thought good vibe about the place, a really, really solid bunch of advisors. And I nearly got more or learnt more out of the chats in the coffees and the few drinks afterwards than I did at the actual conference. So yeah, I thought it was really good.
As it is ever the way. Alan, you got something to talk about it as well, and I know you can talk about it because you're unmuted, and you're unmuted through that entire segment with your shuffling of your papers. Continue, good friend.
I was at the same event with Carl, and as he says, Dimensional put on a good show. One of the things I look out for in the calendar when they announce their and they generally do it a year in advance, their various sort of programs, conferences, workshops. This is one that I tend to put in my calendar. The interesting thing about Dimensional, they've got a program called Dimensional 360, and I hesitate to make this podcast kind of an advertisement for Dimensional fund advisors, but it is one thing that we all agree with. The four of us have in common. We all use their investment funds within our businesses. But the thing I find particularly interesting about Dimensional is they say, look, here's how we think the world operates in terms of an investment philosophy. Here's the evidence. Here's the kind of empirical research that backs it up. Do you engage? Do you want to engage or not? And if you don't, perfectly fine. If you do, it's almost like that's a given now. That's taken. Now, what are the other issues and challenges within your business? And the idea of this kind of a complete view of your business, this Dimensional 360, is they talk about investments. That's all part of it. But then they talk about strategy, because we're all in business. We're all either, trying to start a business, trying to grow a business, trying to maintain a business. What are the key issues, challenges, opportunities that exist? And taking the concept of best practice from around the world. They've got some of the very best businesses around in Europe, in the US and Australia and all around the world who deal with them. So they sort of share this concept of best practice. And the third part of that kind of three-legged stool in terms of the 360 approach is effective communication. How do you communicate with your clients? How do you communicate with prospects? How do you translate this sometimes dull and complex kind of story, investment story, practice management story into effective communication for your clients? So that's what I'm particularly attracted to. I'm not really one of these people who's deep in the weeds on the investment side of things. I find some of it relatively dull. I know other people love it. They spend their time sort of poring over the data and the spreadsheets, but I'm interested in what best practice looks like from around the world, how really successful firms have achieved that level of success, how they're growing, how they're recruiting, how they're retaining staff. And Dimensional do that super well. The last thing I'm going to say is all the people that spoke on that event, and they're all high quality. One stood out for me was a guy called Filip Palaviv, who's a kind of Bulgarian American character, really high energy presenter. He's got 2 books, to my knowledge, which are worth checking out. I put a link to his website in the show notes. Yeah, Carl, for those who are watching this on YouTube, Carl's holding it up. But some really useful, deep insights from Philip, and I thought he was just a high value contributor to the day. Carl, you want to come back on that?
Yeah, just a couple of points. I thought Catherine was the best of the day, by the way. So there you go. Different people have different views. I'd also prefer a full day, Alan, of best practice in advisory firms or whatever. Interestingly, just to kind of come back to the point about the report that Heather Hopkins did about markets going flat. The growth rate for the best advisory firms is definitely down about 5 or 6%, because I was surprised. So they said it's about 17% now as of last year. And I know for a fact, because I've been tracking these, that it was in excess of 20% the previous year. So, the growth rates are coming back a small bit. I loved what you just said there, Alan, about, what are the metrics for the advisors. They actually put it down in a slide. So I've written them down. It's revenue, profitability, client retention, employee retention, and revenue per advisor. So if you have a firm that's kind of in growth mode and you want to track the metrics that the best firms track, there you go. And that's what we're going to do at Metas. We've already put that in place, and we have a meeting on that tomorrow. So best practice. I thought it was brilliant. And loved meeting all the advisors. It was really cool. A big shout out to Rahit, who I had lots of chat with. And just a great guy who's kind of starting out, and I loved hearing his story. I was inspired by him. I really was.
Yeah, he was good fun. Andy.
Dimensional teach financial advisors how to be excellent, so it can't be praised enough. Just to sort of lighten the mood. Yeah, I rocked up after for drinks with you guys, and we had a few pints in a few pubs in Farringdon. We ended up in a lovely Italian restaurant, the best ravioli I've eaten for a long time. Lots of fun.
Anyway, this was quite funny. Carl and I, the serious players here, we were there the whole day. We were sort of consuming all the information. These two jokers rock up for the drinks afterwards.
Yeah,
but it's good fun.
Often the best bits of the conference are the bits at between the gaps and at the end.
But all joking aside, I met a lot of great advisors in the pub, and I've agreed a conference speaker for next year. There's a connection for a conference. There's loads of good stuff that happens with advisors in and around the DFA. So that's
quite a lot.
DFA pitch over.
A lot of Trappists were in attendance, weren't they? Quite a lot of people who listen to this podcast were there.
Yes,
quite nice. Carl was a celebrity. People begging him to have selfies taken with him, showing all their colleagues. It was quite fun. What was your colleague? What did Paddy say? He said it's like hanging out with a celebrity footballer, and you're the sort of non-famous one standing alongside.
They're not selfies. They're Deweys. Deweys are two people, Alan. Selfies are single. Add to list.
Yeah, he texts Keane back to the office going, "For feck's sake, Carl is like a celebrity here." And Keane went, "Oh, I'd say he's hating that."
Right, have we done enough ego massaging? Good. Moving on to this is so M&G is closing its physical property fund, and this is really a very quick trip down nostalgia lane, and just sort of commenting on the changing investment landscape and the way things are done now. When I used to work for Allied Dunbar in the 1990s, we didn't have with profits. We were a totally unit linked. Basically, we were the future. But the future then was hard to sell. You could sell on Appleton High Street because you were flogging with profits, weren't you, Alan? We didn't have that. The closest we had was a commercial property fund, the Allied Dunbar Commercial Property Fund, which invested in bricks and mortar commercial properties, so retail, business parks, offices, light industrial. And it had a very low correlation to the stock market. So it was kind of an alternative thing. And I when I became an IFA, I used bricks and mortar commercial property funds from Allied Dunbar, which was then Zurich, and then L&G, and maybe some M&G. And I stopped kind of using them around the credit crunch because they're highly liquid, these funds. And when people want to come out of them, the fund manager has to sell property, and some of these properties are millions of pounds worth of property. They don't sell all that often, so they're very illiquid, and there were gates put up on coming out of those funds in the credit crunch. So I thought, hold on, I don't need this. So I kind of migrated to using a REIT fund, a real estate investment trust fund, the BlackRock one, which they recently, 2 years ago, they changed to put some ESG garbage in the title. So I thought, well, I'm getting rid of that, and of course I've got rid of that as well now as I use the one fund philosophy. But just a throwback really. So M&G are closing this fund. It was a massive property fund. They're saying they're going to just sell the properties within the fund over time and return it back to investors in the form of cash. But of course, those investors are locked in. So we do cash flow modeling for people, and the idea is that the cash is there when the cash is needed. That's really what we do. And alongside that, we make sure there's always going to be enough cash for future needs. Very difficult now if you're one of these gated property funds, but a sign of the times. These were all the rage a while ago, and that just caught my eye.
Just a quick point on that, Nick. This is the challenge of having what they call open-ended funds with illiquid assets, isn't it? You've got a fund that it can have money coming in and out, but the underlying asset is entirely illiquid. And the challenge then is that they have to keep quite a high, significant proportion in cash to keep liquidity, which then has an impact in the long term, sort of cash drag on the overall yield and return. Just as we are topical tidbits, Mr. Hart and I went and looked. I've got an office in the City of London. Been here for 9 years. We're coming up to the end of our lease, and of course, we're looking around. And of course, everything I'm reading is, well, office rents. There's going to be loads of empty office space. Everyone's working from home half the time. The modern approach is to have a kind of flexi office type space, kind of these WeWork type things, and then have some dedicated offices with some sort of open plan things. Anyway, I went and had a look at an office space last week. Very nice it was, all kind of modern and funky and interesting, and it's in the City of London. And for those people who know about this stuff, just to give you a headline, do you remember, Andy, the guy was quoting, now it's an all-inclusive, all your rent and electricity and all the rest of it, but £248 a square foot. Now that is about 3 times what we're currently paying for our basic rent. Exactly. So this view that property, all these sort of empty office space is going to be desolate and the City of London is going to be empty, etc., for whatever reason, it's not quite true. Now, I think that's a punchy sort of first offer, but wow, I was absolutely gobsmacked when he quoted that rate. Remember, Andy?
Yeah, it was pretty punchy. It was a lovely office, fantastic location, great inside, lovely balconies, etc. But yeah, punchy numbers.
I think you need lovely balconies if you're going to start paying that kind of money, because you might be jumping off them after a year or so. Jeez, that is expensive, isn't it?
Yeah, I can't do client meetings and lovely balconies. That's all I'll say about that.
Yeah, it's a bit more than Limerick, I'm imagining, in terms of the rental. But there we go.
Slightly.
Okay, good stuff.
Moving on.
Okay, so the final topical tidbit, and this could be this could be something that could evolve into a bit of a long subject. Mr. Hart, starting a mastermind, do's and don'ts, good ideas. We have been around the block with this a few times, haven't we, Andy?
Yeah, I think we have, but a couple of people have reached out since then. And I know some people have set up masterminds following on from TRAP. I spoke to a guy, Northern Irish advisor, he's done it. I think Alan spoke to guys in Scotland, they've done it. So I've set up a couple of masterminds over the years. I set up like the Vointis user group. I've obviously created Hum, which is slightly different. It's more like a sort of conference and sort of company.
Andy, the ultra crepidarian Andy, he knows about everything. Andy can't be told anything. His name is Andrew Hart. Andrew Hart.
Oh, beautiful.
I walked straight into that one, didn't I? But the mastermind I'm part of that we quote a lot of the time, I didn't set it up, but I've been part of it about 10 years. Obviously, I'm a key member. So that one is, we meet monthly. We meet in a lovely hotel in London. We meet in the Dorchester. We meet at about 8 in the morning and it goes on to 11. It's an important meeting that we all block out a year in advance. And commitment, as in showing up, is a central tenet to the club. So let's say we have 12 meetings a year. You cannot miss more than 2. It's that strict. Successful clubs. The reason why clubs are successful is because commitment from the members. In terms of what we talk about, it's a little bit like this. We have topical tidbits and then meat and potatoes, let's say, as in meat and potatoes is a talk from someone. Over the years, we used to get people in that sold stuff to financial advisors and they pay a fee to sell to, a room full of 40 people. And obviously, if some of us become clients, it's great. If we don't, then obviously that's their sort of dilemma. Whereas now we don't really do that. We sort of cover the cost ourselves. And then we get great speakers in. I suppose how you're going to start one, I'd start, in an ideal world, you start with 10 people, like-minded people, get a couple of, monthly meetings in the diary. If you can't get 10, then obviously 5's okay. If you get 5 people, you say, right, next month you come back, you've got to bring, a mate or another colleague that a similar mindset. And then within, obviously, a month, it will go from 5 to 10. I don't quite know what more about it. I mean, our mastermind, we've got an email group that we email each other sort of questions, queries, help requests. So again, it's all about community, getting to know people better. We meet people outside of the mastermind, so we'll have a coffee before or after, or go and meet them in an office or have lunch. So you want to get to know the people quite well. We've got a big diverse group of people in our mastermind, 40 people, from little old me, solo advisors, to people that work for, large organizations. I think the mix is good. You could get a mastermind with 10 of you that all use the same platform, all use the same fund, and all have the same sort of message to clients. But that might be a bit hard to continue and scale.
Heaven.
Might be heaven, Nick. Yeah, that's what we're sort of brewing, aren't we? We're potentially going to launch that at some point. Anyway, so that's my start for 10 on this topical tidbit that is almost a meat and potato. So who's next? I think Carl had his hand up.
Yeah, I'll jump in. Quick question, Andy, on the one that you guys are in. Is 40 too many? It just seems like an awful lot of people. And
it's sort of getting to the point where it potentially is. Yeah, if I was really pushed, I'd probably say 25 might be the optimum number. Okay. Alan might have a different view because he's been a member for a lot longer, because he's obviously a lot older than me.
Yeah, it is quite a lot, but you don't you never get everyone showing up. There's always somebody who can't make it on holiday or something. So you generally
do get close to 40, Alan, most months now.
No, it depends. There's a WhatsApp group where people sort of raise questions. There's an email group. So it's a decent community. And you're right, it's the diversity of the group, I think, which is its power. If we're all the same, then we're not learning a ton of each other. It's a bit of an echo chamber. So there's often quite a few things that I completely disagree with within the group. But that's fine. That's where you can probably possibly learn. I don't know this. It's probably beyond our scope. But if we built a website on Trap or something, just had people communicate, I'm in Scotland, I'm in the Midlands, I'm in Newcastle or something, you could, because a lot of these, we've got quite a few listeners now to Trap, if they all wanted to sort of congregate or get together, but we haven't got the scope to set up a matchmaking service. But
yeah. Let me know how that goes, Alan.
Yeah. Can you do it, Carl? Can you get that sorted by the morning?
I can't even get the Irish one off the ground, so that's what I was going to say. I was kind of going to get it off the ground, and then I just got busy with other stuff. But what we have agreed is we're going to put a date in the diary around Christmas for just drinks, and get whoever wants to go to that drinks and just kind of just have a chat and see where we go from there, because I'm not going to do the work for it. I'm just not. There's no point in me saying otherwise. But you never know. If we all met up, it might grow legs. So if there are any real financial planning advisors out there in Ireland, or maybe based on what you guys have said, people who are not but would like to transition, pop me a message on LinkedIn, and I'll be sure to include you and let you know what the date is and when we're going to do it.
I think actually you make a good point there, Carl and Andy. One of the reasons that our group, the Ideas Exchange, is held together for so long is there is some decent admin behind it. There is somebody there who's appointed to organize, send out the agendas, agree who's the chair, and kind of just generally keep an eye on the admin. And let's face it, most of us do not want that role at all. So you've got to identify somebody, or even somebody within an organization. Somebody's got some extra capacity, someone in their team who's happy just to send out the monthly agendas and meeting notes or whatever. And the other thing is we get CPD points, which you guys love, so you can qualify for your CPD, which is helpful.
Yeah, just to amplify that point, the guy who organises the Ideas Exchange that we go to, it's a paid role, because it is a big role, and it's a serious concern, and it's a serious group. Okie dokie. I haven't got anything else to add on that.
Just final point on that, but don't let that put you off. In the early stages, getting 5 people in a decent hotel room in Liverpool is not going to be too much admin at all. But when you're an established organisation dealing with money coming in, people that have not paid, all that sort of stuff, then it becomes a bit more cumbersome. Maybe you'd appoint a chairman, and they'll pay less than the other people. Let's say get a kitty going. Like 5 people will pay 500 quid to get the thing going. Again, it's a business write-off expense, all that sort of stuff. I think the masterminds are really good when something has gone wrong in your business, or there's a real challenging situation that you've got to deal with. The amount of requests that come into our mastermind, does anyone deal with, fill in the blank, really, really complicated situation? And then immediately 3 people say, yeah, I've dealt with that. Yeah, I've dealt with that. Yeah, I've dealt with that. So it's all about...
that's exactly it, Andy, because I had a couple of conversations at the Dimensional gig with some Irish advisors, and On the one hand, I had a problem that I was discussing with one guy, and I've been through it, and then the flip side of that, I was able to help someone else. So 100%, you're absolutely right. Yeah, I need to get my ass in gear on that. Okay, Irish advisors, I'm going to do it.
There's your commitment from episode 31 of the Real Advisor podcast from The Voice. Great stuff. Okay, we've finally managed to thrash our way through the topical tidbits, which tells me we naturally now lead on to the meat and potatoes of episode 31. This was an idea put forward by Mr. Smith. Mr. Smith, a fork in the road, career choices and big decisions.
Yeah, thank you. This, I just wait for the knife sharpening to stop. It's off-putting. Come on. Is it? Oh no, it's peeling spuds.
It's peeling potatoes. You can tell you don't do your Sunday roast, do you?
When you want a man full of testosterone, you want a man who's frightened by the sound of a spuds being peeled.
Yeah. All right. Listen, since we've been running this podcast, I think all of us get sort of inbound, contact, emails, LinkedIn often requests, and I've just gone through in the last maybe 4 weeks a real kind of increase in those numbers of requests just to have a chat, can I pick your brains, that sort of thing. So I've been on a few Teams calls, Zoom calls in the last little while, and I just thought, rather than me one-to-one giving my sort of thoughts and feedback to other advisors, I thought we could just raise it as a meat and potato subject so we can share the information with a wider audience and also get the four of us to contribute. So the issues they're similar in that you've got a number of advisors who, how can I put it, kind of see the light. They've maybe listened to this podcast. They've understood that there's more to life than certain firms that they might be working in. They like the idea of what we're calling full fat financial planning. They like the idea of kind of a sensible, low cost, evidence based investment philosophy. All those things that we've discussed.
Grab yourself a drink, a very long drink. It's story time with Alan Smith.
Alan thrashes his biro on his paper pad in anger when the drop comes in mid-flow.
I'm just impatient. Get on with it. So, look, obviously I'm not going to name any names, but there's a couple of situations. For example, there is a guy I spoke to, seemed like a really, really nice guy. He really gets it. He understands it. And he's working in a firm that, these firms still exist. They're basically just churning plans. They're just sort of looking at a client's current investment portfolio or pension product, for example, and they're going back to the same client and saying, oh, we found this, I don't know, I'll just make it up. Let's say it's a Scottish widow's pension. We found this Aberdeen pension or Standard Life pension or whatever that's 0.001% cheaper. So we're going to move your funds from this one to that one. We're going to charge you 3% plus 1% ongoing. And it's not real. It's not financial planning at all. So this particular individual says, I'm really frustrated. I'm in this organization. This is what we're doing. I can't get my sort of heart and soul behind it. We're just we're not adding any value whatsoever, and we're charging a lot of money. There's other people in sort of large, what I would call vertically integrated organizations, which again are seeing the challenge of the model that they're currently in. So they're looking for what is the sort of the magic bullet, what is the silver bullet, I should say. What are they trying, what is the way out of this? And so the range of options are from, look, start your own company. Now that's an easy thing to say. It's a hard thing to do. And this is why we're going to sort of unpack this and sort of talk it through. The other issue is find a firm that's out there that are doing this stuff that you can really get behind, that you're really going to enjoy and get a lot more value out of the role that you perform. I've done a little bit of matchmaking, but it's just not my job. I haven't got the time or the sort of range of contacts. I have put a few people in touch with each other. I just happen to know. I actually put a tweet out about this last week or the week before and got a few contacts from firms who are doing the real stuff, who are doing sort of good quality work, good quality financial planning. They contacted me and said, look, we're in this area, we're in the Northwest, or we're in the Southeast, or we're somewhere else, and we are actively recruiting right now. So I've done a little bit of matchmaking, but again, it's not a sustainable process, I think. So that's the opening statement. There is a lot of people who have got this, and that's what we called it, a fork in the road. Do I carry on where I am right now, carry on being frustrated? I've seen the light, I want to change. Do I set up on my own? There's all the issues and challenges and risks attached to that. do I find another firm that I can really enjoy working with? So those are the kind of some of the range of options. So I think it'd be worthwhile spending 5 or 10 minutes unpacking this. And I thought what we would do to in order to give some specifics and some detail on this is start with our learned friend, the ultra-crepidarian, Mr. Andrew Hart, and allow Andy to run through his sort of brief career history, going from working in large organizations to setting up on his own and being obviously highly successful, as he never tires of telling us. Andy, how did you get going?
Oh, boy.
Yeah, I'm going to take a slightly different track to what you've gone through, Alan. So I'm going to give a very brief potted history about how I became a financial advisor, really. So I've been self-employed since I was 24. I'm now 42. I had a job once for 18 months. It was the worst 18 months of my life. Anyway, so I came into this mighty profession on the 1st of November 2008. I came from a mortgage broking background. Again, I was self-employed. The mortgage crisis hit. I needed to flap around and work out what I was doing. I did the exams. I became a financial advisor. So I worked for a local firm that was, let's say, I'm going to be kind here, not how I'd operate, my firm now, but they were okay. Their hearts were in the right place, but they weren't really doing the right thing for their clients. So anyway, I joined a bad firm. I was working in a bad town. I won't mention the town again, just to be kind to the area. So it was a rough couple of years. I turned over £13,500 in my first 24 months. Turned over £13,500. I made a profit of £3,500 over 24 months. It's about £150 a month. So could you earn £150 a month for 24 months? I'm not saying your story is going to be the same as mine, but I'm just giving you some back context. I then joined a good firm, Serenity Financial Planning. Good friend of mine, Tina Weeks, runs it, who a lot of people know and a lot of people listening will know. I joined her firm in July 2010. I took on my first financial planning client and charged them £500 for a review. They're still clients now, and I look after over 7 figures for them. They were in a complete mess, so I've done a lot of tidying up for this client. So I worked for Tina as a self-employed advisor, helped her sort of build the company actually in the early days, get the investment philosophy sorted out, yada, yada, yada. So from July 2010 to the 1st of June 2017, I worked for Tina. At the same time, I was building up sort of other revenue streams and companies and things. And then I set up on my own in June 2017. So it's been 6 years directly authorized. It's been challenging. If I had to give you a number, I'd probably say my initial cost to set up the company, to pay for getting the regulations sorted out, having capital adequacy, which is 20 grand just sitting there in the bank doing nothing, office cost, marketing, I'd probably say £70,000. So if you've got 70 grand hanging around, you could potentially go directly authorized. You could probably do it for less. You could probably do it for more, but I'm just giving some context. My advice, so so that's my history, if that's useful for anyone. It is a journey, it is tough, it is challenging. But, if you're seeking excellence and, you want to do the right thing, you're going to have to take some rough years along the way. But my point to people listening to this, I see people that work for great firms too soon in their career. So I'll go and do training at what I consider a great firm. And there'll be 2 people in the room. They're like, oh, we only joined 3 months ago. We're on work experience. It's our first job. And I'll like, do you like it here? And they'll be like, yeah, it's okay. And I think, shit, if you think this is okay, Jesus Christ. The moment you get out there to the real bad stuff, you got to enjoy this. So that's an example of they've joined a too good firm too soon. I say, look, you go and work with a crap firm, but then you come here, you'll be like, wow, this is mind blowing. But they've joined a too good firm too soon. I know some people disagree with that. So I'm all right with going to work for a crap firm, the boss not doing the right things, the investment philosophy a bit all over the place, because then it's up to you to push back and say, well, actually, I don't think that's the right way of doing things. And there's obviously communities like NextGen, there's communities like Trap, there's things like Hum. So there's a lot of ways to consume information these days coming into the profession. When I came in on the 1st of November 2008, I had nothing. I had a new model advisor that was every 2 weeks. So I've rambled on a bit. It's a decision we'll have to make. There's sort of key forks in the road. You need to do your exams. You need to understand how to do the job correctly. You need to earn money. You need to balance that with, do you have kids and family? It is challenging. And as I said, I earned sweet FA for my first 24 months. But luckily, I had a little bit of money saved. I didn't have kids. mortgage rates were low. I got lucky. But yeah, I took a lot of pain for short term, but long term, it's potentially pulling off. So who's next?
You didn't mention the best day of your professional life, the day you met me for a coffee and everything changed.
The day I went for a coffee with the multimillionaire
Absolute
Alan Smith,
shambles.
that then I ended up buying the coffee. Yeah,
That's it. Never let me forget.
The key word, a key word you mentioned there, Andy, was the role that luck plays in our lives in every aspect, not just our business lives, but our personal lives and life in general. Certainly in business, luck is, you can't invent luck. It just happens to you. But when it does happen to you, you got to have the nous to be able to seize it. And I think, Carl, you've got some thoughts around this.
Yeah, it's funny. Before Andy and Alan joined, myself and Nick were just chatting about this morning before we went on air, and that's exactly what I said. I said, we got to admit here that luck plays a massive part in it. And I think, that was definitely a massive part of, how I've ended up where I am. First of all, I left a brokerage in 2010, set up on my own because I had to. And I wouldn't have if I didn't have to be perfectly honest. I then did my own thing for 3 or 4 years. About halfway through that, I was product selling, as I said before. I went, okay, I'm not adding any value here. I'm not getting any job satisfaction. There must be a better way. So I went researching myself. At the time, Friends First, who no longer exist here, they've been bought out by Aviva, ran a course about financial planning. I went on that course and met Carl Daly, who I set up Metas with originally in 2014. And I kind of just took it from there and went, okay, let's research this as best as we possibly can. I do believe people at that crossroads now are luckier because they do have, they've TRAP, but they have DFA. They have loads of different resources they can go to, loads of different people who are willing to kind of help, loads of people who are doing real financial planning. And it wasn't a thing in Ireland at all. And I guess it was, when you were working with Tina, it was in its infancy. So, you are in a better place because there's lots more people to learn from. But exactly like Andy said, we struggled really badly from 14 to 16. I've often told this story where struggled to pay staff. The directors didn't get paid for a number of months in the first 24 months. But it was almost like a light switch. Once it started to happen, then we started growing exponentially. But it did take 2 years. Now, looking back, right, I think that's because we were poor at telling the story about what financial planning is, the benefits of financial planning. And I suppose we were in a marketplace where this was all entirely new. So, if you're in a place whereby you're in a firm that's, inverted commas, a bad firm, and you want to go and do it, I think you're lucky in that you're in an environment where you can go and do it. Understand it's going to be difficult for a couple of years. And I always say that. But if you know that you can sell, right? And don't be afraid of that word. You need to sell, right? Because you need to get out in front of people. If you're a person who's sitting behind a laptop, that's not for you. So you just go and find a firm and just go and work for a proper firm. But if you want to do it yourself, you need to be able to sell. You need to be massively, massively resilient. And you need to just consistently go at it day after day after day. And it will become easier. It's never easy, but it will become easier. But I would say anybody thinking about going to do it, just go and do it. Just go and do it. There's so many people out there who need real financial planning. Go back to Alan's story about the starfish, right? There are so many starfish out there, right? And there's loads for everybody. And Irish advisors just go for it because, there's not enough people doing it. So that's what I would say about it. By the way, just one other point. Working for a bad firm, like Andy said, just to reiterate that point, we met somebody who said he worked for a bank assurance channel and it was just sales. Love it. I'd get my kids to do that because you get proper sales training and you'll understand, can you do it? So, it's a big topic. It's a big topic. I don't know. We can't solve it in one episode here. But yeah, that's my views or some of my views on it.
Thank you. Thanks, Carl. Let me just come in and I'm going to My very brief backstory, I've shared some of this before, was I set up by myself in the early 2000s, actually 2004 by the time I got going. And I was working, as I mentioned here before, we were working for, an institution as was Standard Life at the time. And I joined, so I left there, I left the security. This is the kind of the risk management thing to do. Because a lot of people that I know have got what do you call it? I mean, in fact, they spoke about the dimensional thing last week. Whatever you call it, a gilded cage or something like that. You're in a particular role and it's quite well paid and it's pretty straightforward, it's quite easy. But it's not really for you for the long term, but it's a huge leap. And I think quite a lot of advisors, quite a lot of people are in this. I don't love where I am right now, but I get quite well paid and it's quite secure and all the rest of it. I just knew, I had this view in my life. This is the kind of the regret minimization process that Jeff Bezos talks about. I'd imagine myself being really old, looking back in my life, back in my career and saying, would I have regretted if I didn't take this leap, didn't take this risk, even if it all failed, even if it didn't work out, would I regret not taking the chance? And I said to myself, I absolutely would regret not just finding out what I was made of, finding out if I could do this. And so I left a very secure role, set it by myself. I basically took over a retiring IFA, sort of sole trader advisor, and here's sort of a handful of clients. It was a nice business. It was a very small business, but at least I had something, I had a foundation to get started with. But I took a 50% pay cut day one. And if you say that to a lot of people just couldn't face that. They couldn't take a 50% pay cut because they've got a lot of commitments, a lot of outgoings. And I think that's another aspect in this. And I think we've all mentioned
You've just got to do it, man. I mean,
Well, you don't have to do it, but you can do it. I didn't, like you, Andy, I didn't have a wife, didn't have kids. I just had to kind of feed myself. If I had to live on pot noodles for 6 months or a year, I would do it. Wasn't I? And I did have some money saved. You've got to just increase your chances of survival and success, which means you do have to save up a bit of capital, save some money, change, work out what is the minimum cost. It's that basic financial planning, DIY to yourself financial planning. If I had to, I don't want to, but if I had to cut all the holidays, had to just pay the very basic bills, what could I survive on for a period of time? It's not, and setting up a business by yourself, we've all done it to varying degrees. It's not for everyone. It's absolutely not for everyone. Finding yourself in a good practice could be the advantage. I like the idea, we talk about the role of luck. And I like the concept of increasing the surface area of luck. In order to access more luck, it's true, Nick.
Nick doesn't like this sort of talk. We've had this talk before.
But it's true. How do you increase?
Believing you're lucky.
But consultant speak is barred in this place.
but it's so true. And how do you increase your surface area? You attend events. You go to conferences. You I don't know, the next gen program, you go to a dimensional conference. And it is those chance. I promise, I had a conversation with somebody at the dimensional gig last week over lunch, which is going to lead to a number of other things, which without being there, there's no chance of that happening. So increase your surface area, contribute, go to whatever it is, the CISI, the PFS program, join online debates, online communities, that sort of thing will increase the opportunity because otherwise no one knows where you are or what you're doing. You need to spend time to do your research. Who are the good firms? Well, who decides who the good firms are not? It's up to you. Find out. Research. Go online. Look at their website. See what the materials they're pushing out. You can find out. It won't necessarily automatically come to you, but begin to identify who the best firms are. And of course, you can reach out to them. I think really good people are always in demand. If you've proven that you are a really good person, we kind of spoke about this somewhat in the past as well. If you've created some content, if you've written a blog or a LinkedIn article about your philosophy and your views, and you've shared it with somebody you've identified as being a potentially good firm or a good future employer, then that's going to increase your surface area. No guarantee of things happening. The last thing I'm going to say in very practical terms, I recently interviewed on my award-winning podcast, The Bulletproof Entrepreneur. I interviewed the managing director of the British Business Bank, who now is a close personal friend of mine, obviously, Richard Bearman. And I didn't know about this, but I think there's some practical application for those people who are thinking of setting up on their own. The British Business Bank has got a subsidiary called Startup Loans, and they will lend up to £25,000 with no fees, no nothing, at a flat rate of 6%, which in the current interest rate environment for business loan is very, very competitive. So they will give you some funding if you can prove that you've got a good business idea. So it's not as if you've got no access to capital. But the most important thing I think of their offering is that they give you mentoring. They give you experienced business development people, marketing, sales, cash flow management, all that sort of stuff for free as part of the program. So I think anyone who's got a streak of entrepreneurship within them, but thinks, I just haven't got the capital right now. Maybe I've got a bit of money saved, but I'm not sure if it could last that long. And I put a link to this in the show notes as well. I would check out that organization because they can be potentially beneficial. And the last thing I would say, if you don't want to go directly authorized, and again, this is no endorsement, I don't know, but I do know a couple of people that have done this, and again, do your own research, but Sense Network seems to be the kind of the network to go to. If you want to join a network, is maybe a stepping stone, not go directly authorized. They seem to be, or sort of a number of people I've known recently have set up on their own, have gone through that particular organization.
Yeah, and maybe is SJP an option for these people now that they're going to do lower cost funds, they're going to do full financial planning, and maybe that's a good place to go because the regulation is a big deal now, and it is way more difficult than it was when all of us set up. Certainly in Ireland, it's exponentially more expensive and cumbersome to do it yourself. So there is a way where you can make a right good living doing the right things, but in other firms.
Andy.
A couple of points, yeah. I think that's correct, Carl. I've heard people trying to go directly authorised in 2023. It is a lot more cumbersome, and they ask them, they put them through a lot more qualifying than even I think I went through in 2017, even though it was a really complex application. Yeah, there's also another network that I think people use similar to Sense called Valid Path, which is also quite open to advisors in those situations and makes it as friction. Kumbaya, my lord, kumbaya.
Valid Path.
Kumbaya, my lord.
Sounds like some
Valid Path.
sort of a cult, doesn't it?
Valid Path.
But also picking up on Carl's point, I do say, okay, set up on your own directly authorised or go to SJP. I think all the problems happen in the middle. I talk to hundreds of advisors every single year. All these advisors are happy at SJP and all the DA people are happy. Everyone in the middle is not happy and they're looking to do something else. So that's my two extreme views on it. I mean, this is a bit left field. Me and Alan have loosely sort of spoken about it, but we sat down with a young advisor last week. Alan and I, sorry. Am I writing a letter or am I talking in person?
You're doing both, mate. Words matter.
Keep going, please.
Okay. So me and Alan sat down with a younger advisor who's at a good firm, actually, but he's thinking about setting up on his own. So we spoke to him. We said, what's your personal burn rate? How much money do you have in the bank? If me and Alan were to give you X thousands, what. So I'm just throwing it out there. I mean, maybe if Trap could get a load of funding, we could invest in these companies, with quite low friction, and take a slice of them and then consult them along the way. Anyway, we'll come back to that as a potential thing as Trap goes.
Can I just say what we've done at Meta? So we've a couple of people who have joined or are in the process of joining. So they were in firms that weren't doing financial planning, have a book of clients that they want to serve, I suppose, more properly, but they have all those problems that we spoke about, right? They're married, young kids, mortgage, and going, Jesus Christ, I can't take the. So the way we've set it up, and this isn't rocket science, right? And again, we're just replicating what's been done elsewhere. Is we're just going to say, right, we're happy to bring you in if you're comfortable that real financial planning is what you do. Because that's the only thing we will do. Everybody has to have a financial plan. Yeah, I want to do that. Okay, come on over and we'll just give you a slice of all of the income that comes in and we'll look after all of the other stuff. We'll put a pod system around you. We've spoken about all that before. So look, there's definitely there's lots of different ways of doing it.
You can also agree minimums, Carl. Like, what's the net you need per month? Okay, we'll agree on minimum of X per month for the first 6 and scale it down and then offset.
We've
it.
Actually we've done that for the first couple of years, right? So for 2 years, because otherwise you're incentivizing bad behavior. So we're going to take the long-term view. You need to take the long-term view. And that's good from a regulation point of view as well, that, look, we're not just saying come in on a self-employed basis. We're going to pay you a proper salary. And we'll look after all of the other stuff. We'll put a pod system around you. We've spoken about all that before. So look, there's definitely and we're going to buy into you over the long term.
Yeah, I think the point is that there are definitely some really good firms out there in Ireland and the UK and various other places, and they are recruiting and they are open to bringing in really good people. But if you're in a firm that you don't love for whatever reason, it's up to you to find out who the good ones are. As I said before, just do your research, because I can tell you there are a number of organizations out there who would just love to have a good person in their organization. So do your work. Nicholas.
So some interesting points raised there. I know somebody who I went to junior school with in the 1970s, and he, all his career, he's a chartered accountant. He's run teams within SMEs, nothing to do with financial services. He, in his early 50s, has, in the last couple of years, I believe, joined St James's Place, and he's doing financial services. Okay, he's doing it through SJP, but he's going in there with no clients, very little experience. He loves Trap, by the way. So, Graham, if you're listening, watching to this, you know I'm talking about you. So it can be done via that route. The points you made about balancing the factors, we've all alluded to it. You know, Alan, your situation when you went out from Standard Life, Andy, when you went out on your own. You know, yes, I'm sure it is. It obviously is easy if you don't have family, you don't have kids and so forth. And if you really do think you cannot afford to move, then don't afford to move, okay? If you really have tried every avenue and you're in a job you don't particularly like, but you can't get out of it for various reasons, fine. But I'd be very surprised if that actually ever happens. I went out on my own. I had to remortgage to get my capital adequacy. You have to have a drop in earnings. The world doesn't owe you a living. You know, if you want to join a business or have your own business that's going to be built in your mind's eye, you're going to have to make some bloody sacrifices, man. That's how it works. You give up a loss at the start, and if you do it right, it comes back. Just do it. Don't sit there and be one of those people that thinks 20 years down the line, damn it, I wish I'd gone out on my own. I have far more respect for a girl or a guy who goes out and does this and it doesn't work out, who then goes back to working for a big firm where they're happier being an employee than the person who never tries it. I just do it. You know, there's this quote. There's magic and power in just taking action. Just go out there and do it. And there'll never be a perfect. If you're waiting for the perfect time to go out on your own, or to leave a comfortable big IFA firm and join a boutique IFA firm that's more aligned to your values, and you're waiting for that perfect moment for the clouds to open up, and the Messiah to send you on an angel a little wing message saying now is the time to do it. It's never going to bloody happen. There's never going to be a perfect time. You've just got to do it when you're ready to do it. And that's all I've got to say. I know it all sounds very easy. Nick, I did it. As I said, I remortgaged. I went through 2 years of very low earnings, no dividends or anything, just building up a client bank. It's hard work, man, but you've got to put the work in. It will not be given to you on a plate, but it's out there if you want it, and if you want it, commit to it. Andy.
Great speech, Nick. Ladies and gentlemen, listen to this podcast. If Nick Lincoln can make a success of it, please, you can do it.
Anyone can make it.
Do it.
I can't deny that. I mean, dear Trappists, you listen and watch these jabronis on this. I've seen these men naked. I mean, if you want to, these are barely functioning human beings, and we've all managed to do this. So we can get there. God. Have we given this a damn good come on, because we're coming in now as an hour. Yeah, best part of an hour and a quarter. Shall we?
Yeah.
Because even in Spain, Posty follows me around the world, and there she is at my parents' door. Here in Benaharafi, she's hauled the bulging sack up a very steep hill, so she's sweating profusely and she's struggling. Let's open up some Trappist questions and see what's going on here today. Who's the first one from? Oh, this is someone who's been in contact with us before. By the way, these Trappist questions, you can, as you know, pin tweet at the top of our profile. There's a link in there. You can put your question into a Google spreadsheet. Leave your name, leave your Twitter handle, leave your LinkedIn profile, please. There's also in the so-called show notes a link to do exactly the same. Now, this is from Mr. Stuart Mullen, who doesn't have a social handle. Well, if he had a Twitter account, he's forgotten it. So, Stuart, my kind of moron. Hey guys, love the podcast, as I've said in the previous YouTube review. This is excellent. Apologies, I'm not in the trade, but as an airline pilot planning ahead for retirement, your content is superb, wide and varied. Narrow and shallow. What's your thoughts on money market funds as an emergency fund as opposed to instant access premium bonds? Thanks in advance. No, I can't get cheap flights. Everything is full. Revenge travel. Right, that's a brilliant question. Poses various things. I will come after you, Stuart Mullen, for free flights in due course. What does that
mean? Revenge travel.
I think people catching up. I think after COVID, that's how I saw it. But it's
All right, just travelling a lot. All right,
just travelling for the sake of it, maybe. I don't know. Stuart, come back to us. Not on Twitter because you're not on it.
Right. Andrew Hart.
Yeah, I think the perfect solution for a retiring couple, I'm assuming he may or may not be married, 100 grand in premium bonds, the rest 100% global equities, elegant simplicity, avoid money market funds. Obviously, if you want to have a bit of cash for everyday money in whatever bank you bank with, great. 100 grand in premium bonds, high friction to encash them in, blah, 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 blah. Yeah. Financial plan dictated.
My two penneth on this is back to this thing about complicating things. That the essence of all we talk about is simplification, not complication, if that's the word. Money market funds, and I can tell you from bitter experience, back in my Standard Life days, and I'm not singling them out because a lot of organizations suffered from this, money market funds were invested in also the underlying assets they held were all sorts of weird and wonderful bonds and sort of things, which in the times you wanted them to be safe and secure, they weren't. And money market funds fell. I mean, it didn't fall by a lot, but they fell about 5% or something. That's not what you want for your sort of immediate access, liquid type funds. So don't bother. What are you trying to do? Trying to squeeze out an extra 0.5% return on it? No, as Andy says, premium bonds, national savings, sort of cash or cash-like. But as soon as you go into these money market, actively managed, actively traded, it's just a different asset class. So don't bother.
With the caveat that within pensions, you don't have access to premium bonds and so forth. So there you would go for Stuart, a short dated. This is not advice, by the way, Christ, but maybe a short dated bond fund and or cash at the moment. Now cash, on Transact is paying
cash within a pension.
4.86%. Well. It's an amazing rate. Okay, I am conscious of time this week, so perhaps we'll defer. There's a second question. So Richard Polson, thank you for your question. We will answer that in Trap episode 32, but I do think we need to move on to Culture Corner and get some juicy bits out there. Mr. Hart, same as ever, timeless lessons on risk, opportunity, and living a good life. Muted, Andy.
Oh, I was doing
such
so
an
well,
amateur. Embarrassing.
I've got my dog behind me as well. He snores quite a bit, so I have to.
I'd like to apologise to everybody for that. Jesus.
Okay, so the book recommendation this fortnight is from Morgan Housel, who's a close personal friend of mine. It's called Same as Ever, Timeless Lessons on Risk, Opportunity and Living a Good Life. His first book is one of the greatest books about money. I'm not calling it personal finance, about money, called The Psychology of Money. It was 20 chapters, narrative stories around the area of money and how we make decisions around it and stuff. So The Psychology of Money, 20 chapters was brilliant. I'm assuming this book is going to be great, Same as Ever. As I say, the title says it all. Things that never change around human psychology and human nature. I haven't read it yet. I don't believe it's yet on Audible.
This haven't read a book and you're making a recommendation. Sorry, you can't do that anymore.
I'll get
War and Peace. That's my recommendation. Pretty great. I haven't read it. But
the Old Testament, the juicy bits.
Yeah.
So that's
at least it's out there now that he recommends stuff that he hasn't read.
Yeah, he's heard of. I've heard of this book.
We don't have to hang him now.
I think our next Culture Corner is going to come from when I worked at Standard Life.
What the hell? Right, Carl, over to you.
Anyway, back on track. Carl, save us. Tell us you've read this one, first of all. Have you read it?
It's 17 hours, and I have about 2 hours left, and it's really brilliant at the moment. So it's the Elon Musk book.
He's just extended that, hasn't he, just because of what we're talking about? You're probably 2 hours in, aren't you? You've got 15 hours left.
It is a beast of a book. I've got the book, and I've that one chapter in.
No, I'm right now in the last few chapters are broken up into the days, literally a day on around the Twitter thing and what he was doing. It's absolutely fascinating. Look, he's a force of nature. He's a peculiar individual for sure. He's not like anybody else I've ever come across.
This Andy.
No, not even like Andy, right? But look, he's done Tesla, he's done SpaceX, he's done Twitter, he's done Neuralink, he's done The Boring Company. And I suppose as I'm listening to this book, I'm reflecting on us thinking we're kind of great because we run IFA businesses, you know. This guy is just history will look back favorably, I think, even though the guy he's different than everybody else, should we say, right? But absolutely and utterly fascinating. It's 17 hours long, and as I said, I've less than 2 hours to go, and I've loved every bit of it. I've found myself like trying to go off and listen to 20 minutes of it because I'm like dying to know what happened. And the last time I felt like that in any book was Shoe Dog, the Phil Knight book, the Nike fella. So yeah, absolutely amazing. Highly recommended to everybody.
Okay.
But he's different. He's got the cosmic view, shall we say, that none of the rest of us have. I also have in my culture corner the
from the sublime to the ridiculous.
The greatest.
Surely we don't want to go there. We don't want to go there. We don't want to go there. We don't want to be reminded of Paris.
The greatest backpack of all time. Because everywhere I bring it, people go, that looks amazing. I go, yeah, it is. So if you do kind of a lot of traveling, even if it's like for me when I'm going to Dublin or whatever and doing overnights, Nordace. So I think that's how you pronounce it anyway. It doesn't matter. It's the Sienna backpack.
I think this is worse than the IKEA wardrobe recommendation. Thank you for taking that slot.
Because all business people do a little bit of travel, and rather than bringing your stupid wheelie case, this one is brilliant. You put it on your back. Anyway, check it out. It's €99. You will say thank you, Carl Widger. That was a brilliant recommendation.
Okay, excellent. Thank you. I might actually do that, Wodge. So there you go, Mr. Smith. Good, bad billionaires.
Yeah, this is a relatively new podcast, which I've noticed is sort of immediately gone into the number one slot. It's a BBC Sounds podcast. It's incredible, actually, when you listen to podcasts which are properly produced. They've got kind of music and proper sound effects and really highly edited and produced. But it's good. It's the guy, Simon Jack, business editor for the BBC. And they just do an analysis of billionaires, or various billionaires. I've listened to a few of them now, and then they tell the whole story behind them. And the one about Philip Green, or Sir Philip Green, is quite interesting because they talk about how they got started. They talk about how they made their first million, like from 0 to $1 million, and then that huge leap from $1 million to $1 billion or multi-billions. They've got one about Jeff Bezos. They've got one about, Nick, you would know Rihanna, famous pop singer. Sure she's on your playlist.
Oh, yeah, love her. Yeah. Lead guitarist, yeah?
Something like that.
Yeah.
They got the guy out of the WeWork empire, and then they make a judgment in terms of
Adam Newman.
Was this a good billionaire or a bad billionaire? And some of them, they got the guy, I can't remember his name, haven't listened to this one yet. The guy, I think it's Irish origin. He was a guy who passed away recently, Carl, an American philanthropist. He became a multi-billionaire and gave away 95% of his money before he died.
You can say it, Adam. Philanthropist. Good lad.
Chuck Feeney.
That's the man.
He basically built University of Limerick, which is beside me here. Wow. Yeah, an amazing man. He gave all his money away.
Yeah, so he would be classified as a good billionaire. I'll leave it to your own judgment as to whether Sir Philip Green is a good billionaire or a bad billionaire, or Adam Newman. But it's highly entertaining. They're about 35 minutes long, so I find it quite interesting, quite good. Bad billionaires.
Adam Newman's a thumbs down from the outside.
Yeah, indeed it is.
With WeWork. Right. Okay. Right. I don't have a topical tidbit this episode, dear Trappists. I hope you understand. I've got a few other things going on, so I haven't necessarily time to consume either
acceptable
backpacks or books I haven't read. But I'm definitely. What I'm going to do for the next episode is buy a backpack and not use it. How about that? Yeah. That way I straddle both camps.
Or buy a book and not read it.
Okay, for the love of Christ, 1 hour.
No, you could put an interlayered joke.
Put the books that you haven't read
in the backpack, and then leave it at home and never use it. Perfect solution.
Have it on my shelf.
When I worked at Standard Life, didn't get that one.
Oh right, okay. Stop pitching. Okay, I think we're done. Are we done? I'm sure. Tell me, it's 1 hour 23 minutes we've got. I think we made a damn good hash of that. So that's a wrap for this episode. Thank you, dear Trappists. Do remember to like and more importantly, to subscribe to us on your podcast app of choice, and also to do so on keep on talking on me, and it's great. And to do so on the YouTube channel. He's keeping doing it. I'm going to kill somebody. Lucky I'm in Spain and you're in the cheaper end of Hatchen. That's around us. I reckon. Do leave a 6 out of 5 star review on iTunes. But until the next time, dear Trappists, it's adios from us, and take care of the folks. Goodbye.
Bye now.
Well done, Nick. Thank you. Complification.
That's it. Shambles. That was quite funny, that.